Okay, let's unpack this immediately. We are diving deep into Nextech3D.ai's integration strategy.
Yeah, this one is interesting.
It really is. We're focusing on a pivotal new acquisition and a pretty hefty show of insider confidence that just hit the wires. So for you, we're cutting through the noise to get straight to what this all means.
That's right. The theme here isn't just one company buying another. It's really about the consolidation of this AI-powered event technology space. Nextech3D.ai, you might follow it, NEXCF or NTAR, is making a very aggressive play here.
Right. They're trying to build what they hope is, the one-stop shop for AI events.
The end-to-end platform, exactly.
So our mission today is to zero in on the immediate financial facts, trace how they got here, and then really analyze this cross-selling plan that management is banking on for, triple-digit growth in 2026? We need to see if the math actually holds up.
Let's do it. So let's start with the hard numbers. The results snapshot, just the facts. The big news is this successful completion of due diligence and the closing of the Krafty Labs acquisition. That's set for January 2nd, 2026. So they are officially taking over the asset.
And what did they pay for this new piece of their ecosystem? What's the price tag?
It was an all-cash deal, valued at approximately $600,000.
Wait, $600,000?
$600,000. And now this is the interesting part. For that cash, they bought an asset that reported year-to-date 2025 revenue of about $1.2 million.
So a sub-1x revenue multiple.
Less than half, yeah. And crucially, that $1.2 million was generated at an extremely high gross margin of 72%.
Okay, a sub-1x revenue acquisition paid in cash with margins over 70%.
Oh.
On the surface, that looks, it looks almost too good. So I have to ask, what's the catch? What's the hidden cost of the integration risk here?
That's a fair point. I mean, that's the immediate skepticism you have to have, right?
Absolutely.
Generally, when you see a multiple that low, it implies something's wrong. Maybe integration headaches, client churn, or that revenue growth was just flat.
Yeah.
But management's pitch is that this is a strategic entry point. They're focused on the quality of the clients, not the current revenue volume.
Okay, so we'll get to that.
They believe the price reflects the current size of the contracts, not the potential size.
But this is where the story gets even stronger, because right alongside this low-cost deal, the CEO put his own money in.
Exactly. The CEO, who's already the biggest shareholder, committed another $321,970 to the company. It's through an 18-month convertible note, and it has a pretty hefty 12% annual interest rate.
Wow.
This is, the strongest insider confidence signal you can get. Management is financially aligned right as they go into this really intense integration phase.
Okay, let's pivot a bit to the history here. The asset they just bought, Krafty Labs, give us some color on them. What are they actually bringing to the table besides just great margins?
So Krafty Labs was founded back in 2018 out in New Jersey. They started out focusing on connecting people through these hands-on creative activities. But they quickly pivoted that into curated corporate experiences.
So like team building exercises.
Yeah, exactly. They specialize in both virtual and in-person event engagement and team building. Think about all the remote teams of these massive tech companies trying to keep their culture alive. Krafty Labs fills that gap. A typical engagement, maybe $2,000, might be a virtual cooking class or a company-wide watercolor workshop. It's an HR and employee experience tool.
That makes sense. It's a low-friction sale into a totally different department than typical event tech. But the real headline here, and management keeps saying this, is the client list they're acquiring.
Oh, absolutely. This is the whole engine. They bring an unbelievable roster of clients. We're talking Google, Meta, Oracle, Microsoft, Cisco, Netflix, Dropbox, Spotify, and Yelp.
That's a murderer's row.
It is. This deal gives Nextech immediate warm access to over 400 Fortune 500 accounts. And it's not just a list, right? These are existing relationships inside those companies.
Okay, but access is one thing. Monetization is another. I mean, doesn't everyone try to sell into Google and Meta? What makes this different? How do we make sure these clients adopt a full Nextech suite, not just keep Krafty Labs for small team building stuff?
That's the million-dollar question, isn't it? The answer is how Krafty Labs slots into the existing Nextech ecosystem. They're combining 4 major parts into one seamless offering. Think of Krafty Labs as the high-margin, sticky content engine that gets your foot in the door. It sells to HR.
And what are the other components it plugs into?
The other components are the big platforms they already own. So you have Eventex, which is kind of the core plumbing. It handles all the event tech, like registration, ticketing, lead retrieval, mobile apps, all that stuff.
The infrastructure.
The infrastructure. Then you have Map D, which is more of the venue management layer. It focuses on things like floor plans, booth management, interactive maps. It already supports over 500 events a year.
And even before this deal, Nextech was already streamlining things, right? They reacquired Airway and integrated it with MapD. It sounds like a move to cut out any fragmentation.
Precisely. They are killing internal redundancies, consolidating their tech stack, and just focusing all their resources on this one unified, scalable AI event solution. The idea is that instead of selling 3 different tools to 3 different departments, they're now selling a single AI event solutions operating system. You use Krafty Labs to build trust, and then you bring in the full platform to manage the client's biggest annual event.
Okay, let's shift to the investor context then, because the story really moves from just consolidation to, well, acceleration. When you put all these pieces together, what kind of scale are we actually talking about? And what's the strategy to turn that access into real revenue growth?
Well, the scale has changed dramatically. The combined company now serves over 1,000 global customers. This immediately positions Nextech as a pretty significant emerging player. But the entire investment thesis, what you really need to key in on, is the revenue upside strategy. Management calls it the cross-selling leverage.
So tell us how that works. What's the mechanism that turns a $2,000 client into a 6-figure contract?
This is the foundation of their entire 2026 growth story. Remember, the average customer spend at Krafty Labs right now is tiny, around $2,000 per engagement.
Right.
Management's whole hypothesis is that by cross-selling the full Nextech suite, they can scale those small initial accounts into much bigger contracts. They're specifically targeting a minimum of $20,000 and even up to the $200,000 range.
That's a 10x expansion on the entry count at a minimum, so let's make that tangible for you listening. What specific products justify that kind of jump?
Okay, think about the massive annual conference or the huge sales kickoff that these Fortune 500 companies run. The $2,000 pays for the team-building icebreaker. The $20,000 contract adds the full event deck stack, customized registration for 5,000 people, mobile event apps, AI matchmaking to connect attendees and sponsors.
Okay, so
And if the event is physical, the $50,000 contract could include the full MapD floor plan management and the AOA augmented reality navigation for finding booths. They're moving the whole conversation from team fun to mission-critical event infrastructure.
And we touched on this, but that dual entry point HR teams versus marketing and event teams, that's a built-in cross-departmental sales strategy. It gives them 2 different ramps into the same enterprise budget.
Correct. The sales cycles are completely independent, but they're leveraging the same customer data, the same relationships. Once they have a foothold with one, they can leverage the services of the other platform. It's classic land and expand, just with 2 different types of landers.
Okay, now let's talk about that 72% gross margin from Krafty Labs. As they try to scale these accounts from $2,000 to $20,000, they have to increase the complexity of the service delivery. So how does the AI part of this help them keep or even expand those amazing margins?
That is the definition of the operational leverage they're chasing. Traditionally, coordinating a massive event, it required a ton of people planners, success managers, coordinators.
For a small army.
Right. By building AI into the delivery process, things like automatically scheduling 100 virtual breakout rooms or using AI to create program content, they expect to materially reduce that later component.
So the AI basically automates the work of what would have been, say, 2 full-time human coordinators. That lets them service bigger contracts without just hiring more and more people.
Precisely. The goal is to make engagement delivery more software-driven and less human-driven. That translates directly to margin expansion. It's how they justify that 72% number, even at a larger scale. But this does bring us to a really crucial tension point we need to talk about.
Which is?
The human element of sales. You cannot scale a $2,000 client to a $20,000 client without a significant investment in a really skilled sales and client success team. The risk is that the labor efficiency they gain from the AI gets immediately eaten up by the personnel costs needed to actually execute the cross-sell strategy. That's a huge variable for 2026.
That's a really important tension to watch. Let's circle back to the insider investment for a second, because the structure of that $321,000 note also gives us some important context.
It does. The money covered part of the acquisition price. But the convertible note part is what's critical for shareholders. It's set to convert at a price of 0.165 cents per share, and the warrants that come with it are also at 0.165 cents.
So what's the potential dilution?
If it's all converted and the warrants are exercised, it represents a potential dilution of up to 2,299,412 common shares.
And how does that conversion price compare to where the stock usually trades? Does the structure with the 12% interest favor a quick conversion, or is it about long-term alignment?
Well, given the market context, that conversion price suggests a big vote of confidence that the price is going to appreciate significantly from that base. The 12% interest rate, I mean, that's not cheap money. But by making it convertible, the CEO is essentially taking a 12% coupon while betting heavily that a successful execution pushes the stock way above 16.5 cents. It's a huge signal of confidence in that 2026 outlook.
And the CEO has been very clear about that outlook, saying they already have triple-digit growth in the bag because of these moves.
This stated goal is all about execution now. It's about expanding those relationships with the new blue-chip customers. The foundation is laid. The entire focus is now on the speed and efficiency of bundling and selling the full AI event solutions ecosystem into those 400 new contacts. It is a sales race for 2026.
All right, now we move into the segment where we put on our most speculative analyst hats and pitch a trade idea based on this data. And we have to remind everyone this is strictly for informational purposes.
This is not financial advice. But if we were pitching this to an investment committee, here's the plausible but outrageous pitch. We are buying the idea that the market is dramatically underpricing the revenue acceleration potential here, especially given the tiny $600,000 cash cost and that incredibly high gross margin. The risk-reward, we think, favors the reward pretty significantly if management can execute.
So what's the specific trade?
The trade. You take a long-term position in Nextech3D.ai shares. The thesis is based on the immediate realization of, say, a 2x multiple on that $1.2 million in acquired revenue. Our whole thesis hinges on rapid cross-selling execution. We need to see management demonstrate just a 10% conversion rate.
Just 10%.
That's right. Just turn 40 of those initial $402,000 accounts into the targeted $20,000 minimum contract size by the middle of 2026.
So you are betting squarely on the sales team's ability to get this done, to monetize these big companies across different departments within the next year or so.
We are. The speed with which they bundle that full ecosystem, from AR navigation to registration into those Fortune 500 accounts, is the only KPI we are watching.
Yeah.
This is a pure bet on execution and the efficiency of their unified AI platform. If they hit that 10% conversion benchmark, the market will be forced to re-rate the entire company's valuation.
That's a fascinating setup, especially with that tension between high growth and high margins. Okay, let's wrap this deep dive up.
So what stands out to you when you connect all the dots?
For me, it boils down to the strategic genius of the acquisition paired with that compelling insider alignment. First, the low-cost, high-margin deal for Krafty Labs gives them the golden ticket, that client list, for just $600,000. And second, the big insider investment, even with its high interest rate, is a powerful signal that the largest shareholder thinks the stock is about to take off.
And the convergence is the defining story. By combining MapD, EventDex, and Krafty Labs, they've created a really comprehensive end-to-end AI event solutions offering. This unified platform is now built for multi-department monetization inside these huge enterprises. It's a move away from one-off transactional sales into high-value, bundled, recurring contracts.
So what does this all mean for you, the listener? Here is a final provocative thought for you to chew on. Management is promising that the efficiency from their AI will protect those amazing 72% gross margins even as they scale. But the only way they get that growth is by turning a $2,000 client into a $20,000 client, which takes a lot of human effort. So the ultimate test for Nextech in 2026 is this. Can the internal efficiencies of their AI technology truly offset the required increase in highly paid sales and client success people needed to pull off that cross-selling strategy? Keep watching that headcount against those margin statements.